Hello and welcome to Edison TV. My name is Joanne Collins and I'm an analyst on Edison's investment trust team. I have the pleasure today of being joined by Kirsty Gibson to talk about Baillie Gifford US Growth Trust, which she co-manages with colleague Gary Robinson. Kirsty, hello. Thanks for joining us.
Thank you for having me.
You're most welcome. Let's start by talking about the kind of businesses that you target and the returns that you're looking for from these companies.
Sure. So we're looking to invest in the most exceptional public and private growth businesses in the US. Up to 50% of the trust portfolio can be in unlisted businesses. I guess the starting point, therefore, is to say, well, why exceptional growth businesses? Now, conventional wisdom suggests that a company's growth rate will revert to the mean in time. Exceptional growth is about growing faster for longer than people expect and at higher rates of return. And this matters because continued exceptional growth is unexpected growth. So unexpected growth translates into upside and thus a return for our clients. It also matters because asymmetry drives everything in equities. The total wealth created by all listed US common stocks from 1926 to 2016 was $35 trillion. Half of that was created by just 90 companies. So that's 0.4% of all stocks. So exceptional growth businesses are the drivers of returns. And finally, the companies that grow the most perform the best. And the companies with the fastest sales growth and EPS growth over 5 years deliver the largest total return. So fundamentals are reflected in share prices in the longer term. Now, luckily, we believe that there are some common characteristics which are consistent in these exceptional growth businesses. And that applies both across the public and the private domain. And they're often addressing large and sometimes expanding market opportunities. They have distinctive cultures, which are often run by individuals who care more about the mission of the business than the kind of short-term share price moves. And they are building sustainable competitive advantages. Now, we run a concentrated, high-conviction portfolio, and we own companies for a long time, typically between 5 and 10 years. And we believe this approach remains the best way to capture the outsized returns from those few outliers that drive most of the stock market return over the long run. Although it also involves accepting a higher level of volatility than the wider market. From our public companies, we are looking for at least 2.5 times return over 5 years. And from our private companies, it's a 5 times return over 5 years. The hurdle is higher here to reflect the more illiquid nature of these assets.
You can give us a couple of examples of these kinds of companies that you actually own.
Sure. So in the public space, I would highlight DoorDash, which is a local commerce delivery company in the US. This is a company where its sort of rare blend of operational excellence and ambition has enabled it to perform strongly while other local delivery businesses have really struggled. It now dominates the online takeaway category in the US. It has about 2/3 share. And it's now using its network to expand into other categories, such as grocery and convenience, but also internationally. There is a potential future for DoorDash where it becomes the last mile delivery partner for almost anything that you get delivered to your home from in the US and beyond. In the private space, I would highlight SpaceX, which is our actual largest holding in the portfolio. And SpaceX designs, manufactures, and launches advanced rockets and spacecrafts. So last year, 80% of the mass sent into space was put into orbit by SpaceX. So by fully embracing innovation and vertical integration, they have opened up a series of cost and capability improvements, which are transforming the space industry. And we're excited by the long-term potential this creates and the diverse opportunities being unlocked, whether that be in things like global satellite connectivity or the potential for something like space logistics.
Okay, thank you. And why is the US market a good place for finding these kinds of companies?
So At the end of 2023, 62 of the world's most 100 valuable listed companies were US-based. And if you include Canada's Shopify, which is a platform for entrepreneurs, that brings North America's total to 63. So 63 out of 100 of the most valuable listed business were in North America. The US is even more dominant in young companies, many of which are private. And we continue to believe that the US remains the best place to find and invest in exceptional growth in both public and private markets. And the reasons for this are manifold, and we believe that they will continue to persist. So the US has some of the strongest academic research institutions in the world and a strong talent pool, which until now, and we hope will continue to in the future, has been supplemented by immigration. It has a broad and deep venture capital system that supercharges startups' growth by providing funds alongside technical and managerial advice. It has a strong intellectual property protection and a business-friendly environment. And finally, and perhaps most importantly, the US has an unrivaled culture of optimism and ambition and just a willingness to accept failure.
And what role do you see AI as playing in driving this market going forward?
I think AI is a platform shift. And consequently, it's going to play an integral role in the future of the US market. I expect its impact will be prolific, and most companies will be AI companies in the same way that most companies are internet companies today. However, we are in a very early part of its development, and we're really just beginning to see the potential of AI as a cost saver, but also as a driver of future revenues as well.
Higher US interest rates have been a challenge for some of the high growth businesses. What developments are you seeing amongst your portfolio holdings in response to high rates? And are those developments having an impact on the performance?
Yeah, so I think I would characterize 2022 as a year of reorientation. So many of the trust portfolio companies experienced a valuation reset, and they were faced with a higher rate environment and combined with that demand volatility. And the consequence was that they had to reorientate their business models whilst also endeavoring to ensure that they could execute on their long-run opportunities. So there has been a shift, I think, towards more focus on profitability and cash flows, and companies looking to achieve, a position of sovereignty. They're not being dependent on outside forces to help them to be able to deliver on their opportunity set. So I would describe it as cutting the fat, but maintaining the muscle to deliver on that long-run opportunity. Now, 2023 was much more of a year of execution. Companies were looking to execute on the new priorities. For many, it marked a return to investment during that period. So ultimately, the ship has been steadied, and many companies are now looking forward in 2024 and beyond and saying, what comes next? And how do we ensure that we make those necessary investments that we need to execute? And those companies that we believed could not make that transition and, reorientate themselves in this new environment, well, they were sold from the trust list of holdings. In terms of fundamental performance, to give some examples, we've seen a company like Shopify that I mentioned earlier transition from loss-making to having a 20% free cash flow margin, or something like Affirm, which is a buy now, pay later platform, continuing to narrow its losses as the company's scaling. Or something like Pinterest, which is the online pinboard company, which has returned to user growth. It's built out improvements in its advertising tools, and it's now delivering GAAP net as well.
Thank you. The trust has scope to invest up to 50% of its assets in private companies. To what extent do you utilize this capacity, and what advantages does it give you as a portfolio manager?
So we launched the trust because we wanted a vehicle which would enable customers to access the most exceptional businesses in America, regardless of whether they were public or private. And we wanted to provide that access for a reasonable price. At the end of October, our private rating was 33%. And that number could go higher, or that number could be lower in the future. we want to own the companies we believe will be the exceptional growth businesses over the next 5 to 10 years. And that 50% limit that I mentioned gives us the ability to flex depending on where we see the opportunities. So we're not actively seeking one type or other. We are seeking exceptional growth businesses. There is high competition for capital within the portfolio, and any new company, whether they be public or private, is judged against what we already own and whether or not we feel that, that would bring something to the portfolio or is better than something that we already own. In terms of advantages, investing in private companies enables clients to get the opportunity to participate in more of the potential upside from a company, given many companies are staying private for longer than they would have historically. Alongside the fact that investing in private companies is helping to make us better public market investors, as it's another information source on the competition or new and up-and-coming technologies that are coming through.
Now, your performance has been improving over the past year or so in absolute terms and relative to the benchmark. Can you talk to us a little about what's driving that and where you see the trust going in terms of its performance and its outlook from here?
Sure. So we invest in growth businesses I sort of mentioned that throughout this. And we cannot deny that they have benefited from easing concerns around interest rates. And additionally, the changes that many of the companies the trust owns have made to shore up their resilience, alongside the progress that they have been making in their fundamentals, is being better appreciated by the broader market. I wouldn't argue that it's fully appreciated yet, and that's why we continue to own these businesses, but it's definitely being better appreciated. Our philosophy is built on a foundational belief that fundamentals drive long-term returns. And, we believe that the fundamentals of our portfolio companies are really shining through. So the outlook is exciting, and there's an abundance of growth opportunities. I think we have to remember that the periods of disturbance can renew as well as destroy, because alternative ways of doing things can emerge. So, referencing artificial intelligence again, that just presents a huge opportunity. I'm comfortable saying I think this platform shift will be more significant than mobile, but we are very early in that change. Most of our investments in the trust in this area are in that kind of infrastructure or cloud compute data center layer through the likes of NVIDIA or something like Amazon and AWS. What happens in that middleware layer or the AI model layer or the app layer is much more difficult to predict given how early we are. But we are seeing companies emerging in these spaces doing really interesting and exciting things. So we are very excited about the outlook for the trust. We know the ride will not always be smooth, but we have high conviction in the structural shifts that are moving the portfolio forward alongside the fundamental progress of the companies that the trust owns.
Kirsty, thank you very much for your time today, and thanks for all the information that you've given us. Very interesting. Thanks also to our viewers. If you'd like to know more about Baillie Gifford US Growth Trust, please visit edisongroup.com. Thank you.